It looks like broad-based. This was a slowdown. It was a miss on all fronts. Your take on all these numbers?
Well, we should be expecting a slowdown even no matter what. I think the consensus numbers were just too high, to be frank. I mean, you had 21% growth in retail sales. That to me was already too high. But of course, the numbers are even below our own expectations. And we're talking about Natixis research, which we actually had growth at only 7.8 for the year since last July. So even for us, it's actually low. I think retail sales, we have to realize that, we have a little bit of a wave in China and, Delta all over the world. So I can understand that the expectations were low. What worries me is fixed asset investment. It's not very low, but it should be higher, given that should not be immediately affected because there's plans behind. So that number worries me, and I think 7.8 will keep it, but we're getting very close to that in terms of consensus view after this data. So yeah, it is indeed low.
Can I pick up on that, Alicia? The fixed asset investment. I mean, to your point, it was surprisingly low, but how? I mean, that's more backward looking, I would imagine. Well, that's one part of the observation. The second part is, would it be too early to actually conclude that it was a low number, given that the slowdown did take place only in the last 3 weeks or so?
Yes, let me explain why I mentioned that as a particularly low number. It is because our expectation was that it would be higher, maybe even higher than consensus. Why? Because most of the slowdown in fixed asset investment comes from SOEs. So if you actually divide private and public investment, it was about SOEs, fixed asset investment, being very low in the first half of the year. We also know that the government has been pushing both SOEs and local governments to do more for growth. So I was expecting July to be the start of the second half of the year, the start of a different tone on fixed asset investment, at least from the public sector side. And it seems it hasn't happened yet. That's why I think it's worrisome, because is it about stimulus not being as easy as it used to? Maybe, local governments are worried about consequences of taking the wrong actions. This is why this number is important to me.
So what are you expecting out of the policy front? The markets are pricing in potential RRR cuts. I mean, we saw local government bond issuance just crater just in the last month or so. What form could policy actually take now?
Well, we've been counting on more than one RRR cut for a while, since we saw the first. And the reason is that I think that's safer than cutting rates in China, because there's two things happening. Yeah, the economy is slowing down very quickly. On the other hand, there's also a massive crackdown on shadow banking and any type of suspicious funding method. So in that regard, I think RRR cuts are better because they remain in the banking sector. They're easier to basically to gouge for growth. Local government financing, yes, it's increasing, but the worrisome part is, what are they doing with the money? Are they investing the money? Are they investing it properly? Is it productive? So what the data today shows is that we don't see that in fixed asset investment, and I think that's worrisome.
Okay, and the type of growth that you just outlined there that China is looking to then engender, what should other economies that depend on China, whether that's Australia, whether that's your sources of raw materials, for example, intermediate goods, what have you, do those economies need to be worried?
Absolutely, because we also got trade data very recently, and the trade data also shows that China's growth is moderating. In fact, right after that, quite a few key players downgraded China's growth to a lower number. So trade data is showing that not only is China decelerating, but it's sharing even less of that growth to the rest of the world. And that, I think, is worrisome for many countries. And we've seen that in terms of impact on commodity prices. And frankly speaking, we'll see more, even more than that, in my opinion, on intermediate goods, so anything that can be substituted, so machinery, you name it. And that's part of the dual circulation, part of the import substitution mode in which China is in. All the more now that the economy is decelerating faster than we thought.
And Alicia, how much runway is there left for Asian central banks to be accommodative on the back of a Fed that is looking to start tapering soon?
Well, we have Indonesia, Thailand coming forward. I think they don't have much leeway for different reasons. Thailand doesn't have leeway because rates are so low already. So basically, you don't want to be Japan if you're Thailand. I mean, basically, you don't have room to cut rates further in terms of the actual nominal interest rate. For Indonesia, I think for countries like Indonesia, especially Indonesia and India, it's more about will the current account hit us again if tapering happens in an unstable way. If foreign investors leave, whether it's because they're leaving China because of the crackdown and therefore they leave the whole region, will I manage to gouge the rupee in a way that is not too destabilizing? And if you cut in the midst of that, it's going to look ugly. So basically, I think everybody's worried for outflows at a time that it might not be because of Indonesia, but at a time of a kind of a risk of environment. And that's what you
Alicia,
do not want to cut, no matter what's happening to your economy.
Let's take things full circle here. 8.5% full year is the consensus forecast for China. I know things are downward spiraling right now. Is 8% achievable? Very quickly.
We've never had 8. We always had 7.8 because let's remember what China told us at the beginning of the year, that they would not grow very fast this year. It was their decision, and I don't know why many analysts, including the IMF, had forecast of over 10, because China told us. I mean, whether it's because it's not achievable or whether they really do not want it, because they know, and this is the key, that the structural slowdown is ongoing, and that 2022 will be even harder. On that front, I think it'll be 8, barely 8, if at all. And again, it won't be maybe it won't even be a surprise for China because they told us up front. That's it.